The world's biggest central banks have been on a wild ride. In the past 4 years, the US Federal Reserve, the European Central Bank, the Bank of England and others have had to navigate a global pandemic which closed down the world economy, followed by a resurgence in inflation as it reopened. Central banks have cranked up interest rates rapidly and are now tentatively bringing them down. At the same time, central bankers are grappling with trade tensions and shifting supply chains while keeping a nervous watch for signs of turmoil in financial markets. So this week on The Big View, we're going to talk about what central banks do next and what it means for investors. It's what we do at Reuters Breaking Views. We tap our best sources around the world to bring you fresh insights into the biggest stories on global business and finance. I'm your host, Peter Thalassen. In a moment, we're going to hear from Alex Brazier, the deputy head of the BlackRock Investment Institute and a former executive director of the Bank of England. But first, I'd like to welcome Francesco Guerrera, who's Breaking Views global economics editor. Hey, Francesco.
Hey, Peter.
So, Francesco, you're a dedicated central bank watcher. You've been following these debates about the global economy and monetary policy closely. What makes this such an interesting moment, do you think, for central banks?
This is such an important inflection moment for central banks, right? Because as you were saying in the intro, after the spike in inflation after the COVID pandemic and Russia's invasion of Ukraine, central banks had to move very fast, and some people would argue they were very slow in moving, and to hike interest rates to bring down inflation. Now, inflation is now converging in all the major economies towards this mythical 2% target that central bankers target. The question is what they do next, and they all have different challenges and different options at the moment. Because, for example, in the US, economic growth is very, very strong, and so there's a chance, especially if President-elect Trump enacts some of the policy they said he would enact, there's a chance that inflation might start going up again, in which case the Federal Reserve, which is the US central bank, which has been cutting rates, may have a difficult decisions on their hands in terms of what to do with a rate-cutting cycle and also whether to even increase interest rates. In Europe, the European Central Bank has been grappling with very, very slow economic growth in the Eurozone. And so they have to keep cutting. And if arguably they've been cutting too slowly because the Eurozone economy is flirting with a recession. And in the UK has a very idiosyncratic economy. And the issue with the UK is that growth is slow, but inflation is not coming down as fast as in the other parts of the world. And so the Bank of England has a completely different set of issues and problems. So the issue of what central banks do next is very, very important, not only for them and for their credibility, but also for the well-being of millions and millions of people.
Yeah, but I mean, shouldn't we have had a recession by now? I mean, I seem to remember, when inflation was going up and central banks were suddenly belatedly, as you say, cranking up interest rates. I think there was this expectation that there was going to be a hard landing, all kinds of people who'd borrowed too much money were going to get into trouble. And I feel like none of that has really happened.
I mean, you're absolutely right. None of that actually has happened. And that kind of defies macroeconomic conventional wisdom, which is when you increase interest rates, you break something in inverted commas. And normally what breaks is the employment market. Firms, companies start, react to the higher borrowing cost by firing people, essentially, or not hiring people. And that in the end tips the economy into a recession. Now, this didn't happen this time. And there are many hypotheses as to why it didn't happen. But one of the hypotheses is that, first of all, there was a huge surge in immigration, especially in the US, which kept the labor force high, and so unemployment low. And then the fact that actually the bout of inflation, the type of inflation we experienced, because it was due to two shocks, right? The COVID pandemic and the Russian invasion of Ukraine, so supply chain issues, was actually something that would have come down very quickly anyway. And we've seen it, that it was a very sharp burst of inflation that is now coming down normally without breaking the economy.
Yeah. So you talk to lots of people about all of this stuff all the time, central bankers, professional economists and so forth. Tell me about what made you want to bring Alex Brazier onto the show?
Yeah, Alex is in his unique position because, as you said, he was a very senior official at the Bank of England, so he has first-hand experience of central banking, but also now he's in the private sector. He works for BlackRock. So his day job is to advise investors on how to deal with this current macroeconomic environment, which, as we said, presents a lot of challenges for investors. So he has a unique perspective on both what central bankers are thinking at the moment, what to do next, but also what investors should be doing as central bankers plot their next moves.
Okay. Thanks, Francesco. Let's listen to your chat.
Well, Alex, thanks so much for being with us.
Pleasure. Hi, nice to see you, Francesco.
Nice to see you too, Alex. Let's set the scene for a second for our listeners as well, right? So central banks in most developed economies in the past few years, and certainly in the US, the Eurozone, and the UK, allowed inflation to get out of control after the COVID pandemic. Now, admittedly, there were external shocks that could not have been foreseen, not even by central banks, notably the pandemic itself and Russia's invasion of Ukraine. Nevertheless, they missed it and they had to hike interest rates to a level and with a speed that we hadn't seen in a while. And now inflation is coming back towards what most central bankers target, which is a 2% level of annual growth. So the first question that I think would be on a lot of people's mind is, were the central banks lucky or smart?
I think they're very smart, but I think they also had a really good slice of luck here. I mean, you look back on the last maybe 18 months, and as you say, interest rates increased at very rapid pace to levels not seen since the financial crisis. So the consensus view was a recession is going to happen now. Things are going to break. And that was based on historical experience of kind of rate hiking cycles. But then you look back on the last 18 months, in many ways, they're pretty remarkable. And I think this is the luck piece. Mm-hmm. Because firstly, very high and sharply rising interest rates didn't really break anything. They didn't cause growth to really slow. And I think looking back on it, that's due to two things. The first is, particularly in the United States, the first is that fiscal policy has been hugely expansionary. Partly that's a direct effect of big deficits, but actually it's also the incentives that things like the Infrastructure and Jobs Act, the CHIPS Act, the Inflation Reduction Act, the incentives they've all provided for investment, particularly in infrastructure and factories. And then the second thing that's happened there is the huge AI data center spend by the hyperscalers. That's huge on the scale of previous investment booms. And all of those things have meant that investment in the US economy has held up even with interest rates rising sharply, which you wouldn't normally expect. So growth held up even though interest rates rose very sharply. But then the other bit of luck was that inflation did actually prove largely to be, and I use the T word advisedly, transitory, as they said originally. It was due to pandemic mismatches and imbalances. It was due to a big surge in demand for goods as we were all staying at home and buying stuff online rather than going out and enjoying ourselves. And supply chains got squeezed as a result. And it was due to hiring patterns being very different to the available pattern of labor supply, which pushed up wage growth. Those things are now unwinding and have unwound to a very large degree. And they meant that inflation could come down. But then the third bit of luck, as if that wasn't enough, is that the US had an immigration boom, which meant that sustained strong growth didn't really add to inflationary pressures at all. The US has had maybe 2.5 million immigrants coming in each year relative to a previous decade average of about 1 million. That's grown the labor force at a time when it would otherwise have been under some pressure from an aging population. And so those three bits of luck, demand held up thanks to fiscal policy and hyperscaler investment, inflation proved largely transitory, and an immigration boom that meant the US economy could keep growing without inflation, all added up to quite a big transformation. And what would have been a normal kind of cyclical interest rate story actually became a story about some big structural changes in the US economy.
And obviously, you've been a central banker. When you are in those rooms and when you talk about hiking interest rates to this level, do you kind of expect a recession? Do you think that's the necessary pain that you need to inflict to bring inflation down and to avoid inflation from spiraling out of control, which is what central banks really fear, right?
Well, typically the discussion isn't quite as blunt as that. But actually, and I think this is quite an interesting lesson for how things could go in the future, which I might come on to later, is when you're facing an inflation shock like that, you do have a very hard choice as a central bank. You can either bring inflation down very quickly, and that will bluntly, require a very sharp rise in unemployment and squeeze in wage growth to do it. Or you can bring inflation back down slowly. And I think what was remarkable about this episode was that there wasn't really any public debate about that choice. It was almost as if inflation was high, and inflation is bad, therefore we must stamp on inflation, without any recognition really that there was potentially quite a serious trade-off involved. Now, as it turned out, thanks to these three lucky outcomes, it turned out there wasn't much of a trade-off involved. In fact, it turned out that high interest rates were needed just to keep the economy on an even keel. But that wasn't the picture at the time. And actually, you didn't see much debate about the trade-offs that were faced. But that is the question that they, at the time, were facing. And as we can come on to, they're more likely to be facing in the future as well.
Yes, I do want to turn to the future. In particular, I think we have to here distinguish between different geographical areas. So let's start from the US, which, as you pointed out, has had the best crisis in this case, for all the reason that you pointed out. So the debate has moved, as you said, from the potential for what in the jargon they call a hard landing, so a recession, to now this idea there will be no landing, which essentially means the economy will keep growing. So that poses a whole set different questions for the central bank. So first of all, how do you assess the possibility and probability of a no landing? And how would the Federal Reserve, in this case, have to respond to that?
Well, take the no landing scenario. As you describe, it's kind of continued growth, inflation coming down. That's actually due to, number one, those things we discussed before. Number one, growth holding up even as rates went up because of fiscal policy and private sector investment, and inflation proving largely transitory in an immigration boom. Now, if that continues, and we can come on to why that might not, actually it means interest rates don't come down very far. Because in the face of looser fiscal policy and a private sector investment boom, actually the level of interest rates that just keeps the US economy on an even keel is substantially higher than it used to be. And that's really now what the market is pricing. In the jargon, the neutral rate, the neutral level of interest rates, the level that doesn't really kind of put its foot on the gas or its foot on the brake, is much higher than it used to be. So the market's pricing interest rates not going very far below 4% now by the end of next year, which is a huge change relative to pre-pandemic. I think the risks, and I think the scenario where you actually get a hard landing now is a low probability event, but it is possible to construct. But a lot of things have to kind of fall away. It's unlikely that fiscal policy is going to tighten aggressively. It is unlikely that the AI investment boom will suddenly come to an end. So you're going to see continued demand strength. So to really get a kind of hard landing scenario now, you need the Fed to actually want to tighten policy further. And maybe inflation proves sticky. It's not down at 2 yet. It's hovering around about the 3% level. Wage growth looks a bit sticky. There's the prospect of tariffs, which could add to inflation pressure. All of that could prompt the Fed to want a renewed bout of tightening. But even then, you could probably get inflation back down to 2 with a period of sub-trend growth. So not a particularly hard crash. To get that really bad scenario, you also would have to have a sudden stop of immigration. Possible, so that the Fed needed really very weak growth in order to push inflation right down. So it's possible, but you have to basically knock away all of those planks of what's led to performance so far.
And assuming, as I do, I don't know if you agree or not, that economics is more art than science, right?
I definitely agree with that.
I'm glad. How does the psychology of the Fed, of any central banks, in your experience, play a part in this? So, as we said, they were sharply criticized by all and sundry for missing this inflationary episode, right? Whether that's correct or not is a different story. So now, surely they are skewed towards a repeat of that, right? An inflationary episode. So presumably there is a bias towards over-tightening rather than under-tightening. Is that correct?
I think that's probably, this is the sort of once bitten, twice shy version of central banking. I think there is something in that, and that's why I would expect them to be reasonably alert to renewed inflation pressure. But there is a but to this, and it's this trade-off point, because it's kind of easy to talk tough and say, I want to bring inflation down very quickly. That sounds great, until you say the price of that is a sharp rise in unemployment, particularly if you're the Fed with a dual mandate. So I would actually expect to see in a renewed bout of inflation, in any renewed bout of inflation, much more openness about the choices available and how, frankly, when you've got an inflation shock, there isn't a universally good outcome at that point. And the same is true in Europe and the UK as well. And I think this is a kind of regime shift. We've gone from a world where actually central banks, most of the time, their job is to stoke up inflation because you've got China integrating into the world economy. You've got global traded goods prices coming down, all of which is just dampening inflation the whole time. So central banks are constantly trying to stoke inflation back up again to get to their target that you described of around 2%. The result, inflation's on average a bit below 2 because they're never quite successful. And interest rates are below their neutral level. So they're trying to run their economies pretty hot. And very importantly, anytime growth threatens to slow, interest rates are cut very sharply or monetary policy is more stimulative. And there used to be this great chart, particularly in the UK, of how monetary policy was basically a sharp response to the early warning indicators on activity from the purchasing managers' indices. That was all you needed to know. Now you're in a different regime where if inflation on average is kind of being shocked upwards, and as a central bank, you're trying to drag it back down, you've got to do the complete opposite. You've got to be running the economy a bit cold, have your foot on the brake to try and squeeze it down. You're going to end up with inflation on average above target. You're going to, on average, have the economy running with slightly higher unemployment because you face this difficult choice, and you're going to have slightly higher interest rates. And that, for investment purposes, is really interesting because it means you've gone from a regime where anytime growth threatens to slow, interest rates get cut really sharply. So you get this lovely negative correlation between long-term bonds and growth and equities. Now, kind of causation's the other way, which is if you have an inflation shock, interest rates go up and growth comes down. So you've got a much less reliably negative correlation between stocks and bonds, which has super important and super interesting implications for the way you think about investing in that kind of world.
Definitely want to go back to the investment implication of this. But before we do that, and since we talked about inflationary shocks, I'm going to mention, you mentioned one T word, transitory. I'm going to mention the other T word, Trump. So could he be, or could his policy be that inflationary shock? Because if you think about it, he's talked about tariffs. That's an inflationary measure. He talks about, incredibly, deportation of 11 million illegal immigrants, which would be a shock to the labor supply and a humanitarian shock, let's just say that as well. How do you rate the possibility that his policy create that inflation shock that the economy doesn't need at the moment?
Yeah, I think it's very plausible that the new policy agenda, and we'll have to wait and see what it actually does comprise of, that it's inflationary. And you can see that in the way bond prices have moved, in the way inflation expectations have moved since the US election. I think the difficulty at the moment is that nobody knows quite how far those policies will be enacted. It's very likely that we will see some form of tariff. That is going to push up inflation in the US. It is going to push down growth elsewhere. It is going to add to this general trend of traded goods prices in the world being higher, because as the world becomes more protectionist, we're effectively rewiring supply chains deliberately to be slightly less efficient than they used to be. So that's inflationary. I think as immigration is cut, and it's coming down already with actions under this administration, but it'll come down further. That will slow trend growth in the US. I think the thing on the other side, though, is that actually productivity growth has been reasonably robust in the US. And there are signs now of companies actually generating efficiency gains using AI. It's not widespread, but it's there.
Mm-hmm.
Actually, as that takes off, just as the internet did in the 1990s, you could actually see some uplift to productivity growth across the US economy, helping to offset some of this other weakness on the supply side. So it isn't all negative, but yeah, I think on balance, those two big macro policies are inflationary.
And so let's think about, because in your day job, you do advise investors on how to position themselves for the macroeconomic climate. So what's your sense, given what you describe as the climate going forward, how should investors position themselves?
Well, I think there's a couple of points, and it sort of depends on the time horizon of the portfolio. So the first is that, as we've seen following the election, US stocks have performed very well with expectations of deregulation, a tax cutting agenda, of a kind of growth focused agenda or an earnings focused agenda in some respects. That's probably got further to go. The other is AI. That revolution is unfolding. We are still in the early stages of it. It's been priced in some of the more obvious and public sectors like semiconductors and some of the hyperscalers, the big tech companies. The really interesting opportunities associated with that now are around which companies can actually use it to raise their efficiency and productivity levels, and who will provide the infrastructure, the data centers, the energy supply to power those data centers to actually deliver on the promise of AI. And all of that creates investment opportunities that are pretty specific and require some pretty careful selection in public markets and, very importantly, in private markets as well. So portfolios have to think about the opportunity set, not just across the public market sphere, but across private markets as well. But then I go back to this sort of inflation point and the correlation between stocks and bonds. And that has really interesting implications for the way we think about portfolios, because the old school portfolio, the kind of classic 60-40 stocks bonds, was built around this nice feature that long-term bonds were a pretty good hedge against growth weakness and hence equity weakness. Actually, if that correlation is now less reliable, as it has been in the last few years, then it forces you to kind of rethink, well, what's the role of fixed income in my portfolio? Do I want so much duration in my portfolio in the way some of the baseline indices actually have? Or do I want shorter duration? And do I want to exploit many more of the opportunities there are now to earn income in fixed income at shorter duration from income generating assets, asset-backed securities, CLOs, sub-investment grade bonds, emerging market debt? All of that in opportunity set suddenly becomes more interesting if you're less focused on long-term duration because it's less reliable in a portfolio. And then on the equity side, without that lovely negative correlation, actually it's an interesting question about how you should think about broad market risk in equities. Should you dial it down and instead replace it with risk in individual securities, which is consistent with not making broad market bets in this type of environment, but actually focusing investments on where will the winners and losers be from the AI revolution? Who is prepared and ready to adapt to this structural change? Who will win? Who will lose? So you end up with an equity sleeve in the portfolio that's much more about taking idiosyncratic company level risk and less about taking broad market exposure. So it's a pretty fundamental change in the way we think about portfolios potentially. And they're really interesting questions that many clients are grappling with, and depending on their horizon and their objective, they're coming to different answers. But this is an interesting environment to do it.
It sounds though like you're saying that there is more space, perhaps for the first time in decades, for active portfolio management, right? So again, for context, the biggest trend of the past 15 years has been a huge move towards passively managed funds that track an index. You're saying that you have to take idiosyncratic risk, so you have to pick the winners and the losers, and that's something that most portfolio managers or most portfolio, the people who manage portfolios are not used to doing because they invest in these huge passively traded funds.
Yeah, and I think this is to do with the regime change. In the so-called Great Moderation, inflation's very low, central banks are stoking everything up to try and get back to target. Then actually, you've got falling long-term interest rates over time. That's obviously lifting bond prices, but it's also lifting equity prices. So it's a rising tide that's lifting all boats. So even when you look back, best thing to do, just buy everything. Actually, in an environment where you haven't got this nice negative correlation, and where you've got big structural shifts going on within economies, more of the potential return on offer comes from careful selection rather than just being in the market. Now, that creates, we think, more opportunities for active management for longs and shorts as well, for market neutral exposures, creates more opportunities for investors themselves to be much more precise. And as the index world has developed as well, there are many more precise indices available to do that. But more generally, yes, I agree with your question. It's about being more active in every sense of the word to exploit these opportunities.
And a lot of our conversation is focused on the United States because that's where we say that the inflationary boom, if you like, is going to happen. That's where the AI boom is also by and large taking place. So how should investors think about other developed economies and emerging market economies in their portfolio construction?
Well, let's take this side of the Atlantic, UK and Europe. And actually, they haven't had the same luck that the US has had. So very sharp increases in interest rates did actually stop growth. We haven't really had much growth in the US or Europe, in the UK or Europe for a few years now. And that, in a sense, that's monetary policy doing what everybody would have expected it to do. Inflation's coming down. But the other thing is that it turns out Europe and the UK have actually needed almost no growth in order to avoid further inflationary pressures. And that's because in contrast to the US, which has had this kind of supply side boom from immigration, Europe and the UK have had the opposite. They've had very weak productivity growth. And that's meant that those economies just haven't been able to grow so rapidly. And so when you look at the different performance of the European and UK market to the US market has been exceptional. Actually, it reflects the fact that the US has had a positive supply side development, strong productivity growth, strong labor supply growth. The UK and Europe have had very weak productivity growth, and despite some immigration, not particularly strong labor supply growth. So very different kind of underlying picture, and therefore much easier to construct scenarios where you have recessions. If inflation proves a little bit sticky, central banks need to tighten a bit further. Well, actually, you end up then with growth negative. I think, though, the interesting investment angle here is with that differential performance across the Atlantic, there's opportunity, particularly in things like fixed income, to exploit the different performance. And to us, one of the interesting things had been that the market was pricing the Bank of England, the ECB, to cut rates very gradually, but to end up at levels of rates much higher than pre-pandemic in the same way that the Fed would. And as we discussed, there are good arguments for thinking that rates will end up much higher in the US than they were pre-pandemic. Fiscal policy, the AI investment boom. Actually, in Europe and the UK, those things don't hold to anything like the same extent. So we have seen opportunities in long-term bonds in Europe and the UK simply because the growth outlook is much weaker. So there's a flip side. And I think the interesting investment call here is that you've gone from a world where things are pretty synchronized. Everyone's facing the same trend, declining long-term interest rates, to one where now very different performance, thanks to different fiscal regimes, different approaches to AI, and the US exceptionalism as a result of that. We've seen opportunities, therefore, to effectively go into Europe in fixed income relative to the US. Now, on the emerging market front, I think the same point you made earlier about being active actually comes to the fore, because this is now an asset class that's highly differentiated in terms of prospects. You've got China now facing severe growth challenges, but you've also got economies who are set potentially to be winners from the rewiring of globalization. And that's countries in the Middle East, in Southeast Asia, Latin America, all of whom are well placed potentially, or better placed than others, to win from that rewiring, and also to win from the huge increase in demand we are going to see for natural resources to power the AI revolution, power the energy transition in particular. So again, a bit like company selection, emerging market selection is going to be much more interesting in future than perhaps it was in the past as well.
Very interesting. I want to conclude on a gloomy note, or depending on how you answer the question, it might be a positive note, but I'm going to start with a gloomy note. Going back to the US, I mean, we talk about the fiscal expansion, we talk about some of the Trump's likely policies. This is a country that's already running a budget deficit of more than 7% of GDP as we stand now, with pretty much full employment. So what are the risks of, shall we call it a Liz Truss moment, or a bond market tantrum at the size of the fiscal deficit of the US, which is not getting any smaller?
Yeah. Let me end on a maybe just the glass is half empty, half full at the same time kind of tone. So it's very clear that the US fiscal position is unsustainable. It was unsustainable before the US election, and it's probably not going to be tightened aggressively. Let's just put it that way, post the election. So the level of public debt to GDP is on a rising trend with these big deficits. Now, The difference, though, between the US and the UK is that the US is the global reserve currency. It is unlikely to have that kind of moment that the UK had, and doesn't have the same, I think, sort of vulnerability that the UK gilt market had associated with LDI at the time. So the risk of a kind of sudden, sharp move in long-term US treasuries is much lower than it was in the UK at that time. But that said, this fiscal position probably does mean more volatility in the long end of the US curve. It means the US Treasury will be having to pay up to issue more in future. And we've seen yields rising since the election.
Yeah.
And they're likely to rise further, which is, again, one of the reasons why people are rethinking the role of duration, which used to be a very nice hedge and may now actually be a source of risk in and of itself.
Mm-hmm.
So they're rethinking the way they put together their fixed income portfolios, leaning towards that shorter duration, that income generation, rather than kind of long-term hedging property of fixed income. So not such a risk of that sharp moment that we all are scarred by in the US, but still an unsustainable position, not likely to be resolved for some time, and hence more volatility in the long end and rising yields in the US. There you go. The glass has got some water in it, but it's not full.
Not full, but it's got a dollar bill in it, because the dollar is what prevents it from being completely empty. But on that note, which is reasonably positive, I think I want to thank you for being with us and for providing me so much insight. Thanks so much, Alex.
Pleasure. Nice to see you, Francesco.
That's all we have time for this week. Thank you, Francesco and Alex Brazier, for that fascinating discussion. This podcast was produced by Oliver Taslich in London. You can listen to a new episode of The Big View every Tuesday on the Reuters app or your favourite platform. Don't forget to tune into our sister podcast, The Viewsroom, every Thursday, as well as the other great podcasts from the Reuters team. If you liked what you heard, please follow The Big View and let us know what you think. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.